Welcome to the listeners to the Bose Wealth Management Tax Efficient Transfer of Wealth podcast. With me today, I have Stephen Misiolek. Stephen, maybe you just let me know where does life find you today?
Well, the picture in my background is actually our head office in Tampa, Florida. I am not there. Today, I'm in beautiful downtown Toronto at our 200 King Street offices.
Very nice. I'd like to let you know that the episode we're going to be filming today with Stephen will be addressing the tax-efficient transfer of wealth for business owners and even families who are looking to keep their legacy carry on into the next generation. As both a CPA and my years counseling wealthy families, this subject has to be one of the most common touch points that I come across. It has been highlighted in recent surveys as well that questions founders and successful people in general. What are the most prevailing concern they see in the continuation of either their business or their own personal wealth that they've created for themselves? And the first concern that they've expressed is, how do these individuals who've managed so well throughout their living years to ensure the smooth transition of wealth to the next generation? And the second concern they'd like to talk about is what means exist to mitigate the impact of the taxes that inevitably fall into the hands of the estate and the executors at the end of life. So that transitioning process is quite complex. So what we hope in this session is to provide our listeners with the answers and some clarity that address both these impactful concerns while bringing to light other tax-effective solutions. So with me today is my colleague, Stephen Misiolek, who is Raymond James's personal insurance planning specialist. Stephen is a seasoned financial professional with extensive experience in estate and insurance services for over 40 years. Stephen has been helpful to individuals and businesses to protect their assets and income through the critical stages of their financial lives, whether it's accumulation, distribution, or conservation. His expertise is rooted in creating tax-efficient plans that are tailored to the unique needs of each client. As a certified life underwriter, Stephen offers expertise in estate creation and continuation, along with business succession planning. Stephen, thanks for setting some time aside for us, as I know you service a number of my colleagues at Raymond James, both in Ontario and Eastern Canada. I'd like to open it up and ask you, Stephen, most clients are aware of the need of life insurance to cover debts like your mortgage, how to protect families in the event of premature death or disability, critical illness, etc. But lately, there's been a lot of discussion on insurance in the wealth space. Can you elaborate on that?
Yeah, absolutely, Jim. And thank you so much for having me here today. Most of the individuals that we would deal with on a day-to-day basis, when you mention the word life insurance, they often think of it in those circumstances. It's pretty easy to convince a young family that they should own some life insurance and disability insurance in the event that somebody passes away or becomes disabled prematurely, and there's a financial hit to that family. So that's often a pretty easy conversation. The conversation around life insurance in the wealth space is really quite different. This is not something that you need to do, but it's something that you might want to do because you have the ability to do it. We often say, why do people do certain things? And they do certain things because they can. And wealthy people can take advantage of some of the things in this strategy. So commonly, Jim, as you mentioned, we talk about 4 basic pools of capital that we all have within our portfolio. And I have them up there on the screen for clients to see, and they're all pretty straightforward. If you're lucky enough to have a pension, you know that you got some tax relief for depositing to your pension. Maybe your employer topped it up, and then you retired, received your income, and any income you received was taxable. If you happen to have a spouse, some of that income or all of it could be transferred to your spouse. And when the second of you, two of you passes away, then there is no residual benefit to that pension. And if you're lucky enough to have collected it a long time, it's a great deal. If you happen to die prematurely, it's not such a great deal, but that's just the way it is. So there's no big estate impact from a pension. Your RSP is a little different. So you deposit money into your RSP, get tax deduction, you accumulate money in there and don't pay any tax on the growth. The minute you start to withdraw any money from that RSP, whether it's through a RIF or an annuity, or you take some money out prematurely or before you retire, you pay tax on any of the money that you take out. When you pass away, whatever is in that RSP residually then gets transferred to a spouse free from tax. One of the beautiful things about the Canadian tax system is that most or all of your assets can be transferred to a spouse without any tax. When the second of you passes away, whatever residual amount is left in that RSP RIF is 100% taxable to the estate in the year that you passed away. So if that residual amount is in excess of $250,000, that throws you into the top marginal tax bracket in Canada, and you're going to pay about 53.5% tax on that residual amount, or your estate is going to. The fourth pool of the third pool of capital, is your tax-free savings account. Tax-free savings accounts, we know we don't get deductions going in. We get tax-free growth. We don't pay any tax on the money that we take out, or our beneficiaries don't pay any tax if we've left it to them in our estate or name them as the beneficiary. The challenge is the deposit limit now is only $6,500, so your ability to accumulate significant sums of money in a tax-free savings account are a little bit limited, but we do love them. And the fourth pool of capital is everything else. It's your investment portfolio, your savings account, your GICs at the bank, the shares you might hold in a private corporation, your cottage, the rental property that you might own, a commercial building you might own, or any other assets. So the typical assets that produce income, either from your portfolio or a savings account, a GIC, interest and dividends, we pay tax on those as we earn them. We don't actually receive that money. We might reinvest it, but we still pay tax on whatever we've earned in interest and dividends, add that to our income and pay our appropriate amount of tax. Capital gains are the tax that we pay on everything else. These are the things that we accumulate in value and don't pay tax on the growth of them. So like our family cottage, like the shares of my corporation, like a stock that I've held for a significant number of years. And so the tax on those items is due when I have disposed of that item, of that capital asset, whether I physically sold it or whether it's deemed to have been disposed of at my death. All assets are deemed disposed of at my death. So very quickly, Jim, the easy calculation for capital gains is I acquired an asset for $1. When I disposed of it, it was worth $10. That's the fair market value. The gain on that is $9. Half of that amount is taxable. So $4.50 is added to my income in that year, and I pay the appropriate tax. Now, of course, depending on your wealth, you have to add a number of zeros to that calculation. So in most cases, the combination of tax between accruing capital gains in an estate and the residual amount of an RSP are the two biggest factors that mitigate and impact the amount of wealth that we actually transfer to the next generation. And that allows us to introduce this fifth pool of capital. And the fifth pool of capital is tax-exempt life insurance. Tax-exempt life insurance allows us, or is a system that we use to move very small portions of my portfolio into this pool of capital, this tax-exempt life insurance pool of capital. Typically, that transition or reallocation is 1 to 3%. By reallocating 1 to 3% into this pool, I've created an asset that behaves very much like a TFSA. There's no deduction for the deposits. There's no tax on any of the growth. And the benefit that is paid out of the policy when we ultimately pass away is paid out tax-free. Typically, the objective is to create a pool of capital here in number 5 that is equal to or greater than the total amount of tax that's going to be due to my estate, therefore mitigating the impact of tax to my estate. What I should mention is, because we're in the investment business, and you said that I'm concerned about accumulation, distribution, and conservation, we have to think of this as an investment. And will that reallocation of capital provide a positive rate of return to ultimate benefit? And in most cases, Jim, we find that it produces an internal rate of return of between 6 and 8%. And most of our clients and financial advisors would find that very attractive, considering that we're typically talking about a time frame of 20, 25, or 30 years.
So there appears to be a very clear roadmap that sort of shapes the conversation there. Can you go into, if I'm a business owner, if I'm talking to the business owner, what's the mindset there? What's the solution for somebody who's running a corporation, has shares and a stake in something about an enterprise?
Absolutely. So I mentioned that in that fourth pool of capital, the shares of your private corporation could be a part of that. The taxation in a corporation works very differently. I put together this chart that I think explains the situation of taxation of a corporation. So I've got income that comes into my corporation. I pay tax at the corporate level of whatever the net income is in the business. That's up in the top left-hand column, or the blue square. I don't know exactly how it shows up on your screen. And then I pay myself out some salary or some dividends, and I pay a little bit of tax on that money. Then if I'm lucky enough, I've got a whole bunch of money that's left over, and I invest it. I keep it in an investment portfolio in my corporation, whether I use that for expansion or whether I use it to, purchase it on the business. Most of our clients just have that money sitting there, and they earn interest and dividends and perhaps accrue capital gains in that portfolio. So it's just like a portfolio would hold personally, but I hold it in my corp. The challenge is that since 2018, the very first dollar of income that I have from these investments, or passive income that I have from these investments, is taxed at the highest marginal rate. So I'm going to pay 53 cents of every dollar I earn interest in, going to pay almost 40 cents in every dollar I'm going to pay on dividends. And then capital gains we had a little bit of conversation about that, how they are taxed. The other challenge is if I have some money in that investment portfolio in my corporation and I decide to take it out, well, I have to pay another dividend tax to put that money in my pocket. So it's often punitive, and we call that trapped surplus in the corporation. So if I'm in one of these situations where I established my corporation a long time ago and then the government changed the rules on taxation, I have what's called trapped surplus in the corporation. The concept of what we call the corporate estate bond is that we move some money from this investment account into tax-exempt life insurance, repositioning that money, reallocating that money in tax-exempt life insurance. We mentioned earlier that anything held inside any growth inside the life insurance policy is exempt from tax. And then when that individual passes away, that money flows into the corporation fully tax-free. That mechanism of the life insurance policy hitting the corporation creates a carrot to something called the capital dividend account. Without getting too detailed, the capital dividend account allows the surviving shareholder, to declare a tax-free dividend out of the account. They get that money out of the corporation fully tax-free. So by repositioning the money into life insurance, that flow of capital now comes out of my corporation fully tax-free, rather than having to come out as a taxable dividend, which can be very attractive. We talked about earlier the internal rate of return of that flow of money. And if I talk about the flow of that money, that rate of return in a corporation is enhanced because of the intrinsic tax that's paid inside the corporation. And that rate of return is often in excess of 9%. So a very attractive means for a corporation to redirect a small portion of their portfolio for a very significant tax benefit at the end.
That's pretty efficient in terms of what we're trying to capture here. Thank you. Excellent slide, Stephen. There's a lot going on in that slide, but I think if you're a business owner, it probably resonates what that capital dividend account can do as a benefit at the end of your working a corporation to that magnitude.
Yeah,
excellent.
I mean, we have oversimplified it in this slide, Jim. There's a lot more moving parts in there, as you know, but for illustrative purposes, I thought this was the best way to explain it.
Excellent. Yeah, no, it's terrific. Thank you, Stephen. Excellent. So I'm going to leave the subject matter as is. I think the information being presented today should help anyone get the conversation going in their own thoughts, in their own private moments, so that that conversation can carry on both at the dinner table and ideally with advisor like yourself to carry on that very important answer to the concerns wealthy people have who want to pass on their legacy. I'd like to take this opportunity to thank you once again, Stephen. I think we addressed the subject of a tax-efficient transfer of wealth that would be a great solution to a couple of major concerns for transitioning wealth, whether it's on a personal level or a corporate level. To our listeners, remember, it's important to thoroughly review and discuss the topics covered here with your financial advisor. Each situation is unique and should be analyzed based on the facts and concerns of your particular situation. Raymond James works with a number of insurance providers to select the best options for you as our clients. This means that our clients' requested needs can be matched up with the right insurance product. So our goal is to put the client first. I'd like to take this opportunity again to thank Stephen for the time and wisdom as he covered some important points in today's podcast. As always, the team at Bose Wealth Management looks forward to hearing from you and guiding you through the discussion of this concept and issue. Feel free to reach out to me personally, Jim Viduris, at 416-581-0081, extension 209. And I'd like to thank you for taking this time to listen to this episode on tax-efficient transfer of wealth. Have a great day.
Thank you.